We're here to talk about money. It's a very tough act to follow, a dance group, but we'll try to do it. Specifically, if you go back to the 1990s, one critical step in the whole digital economy, companies going public, innovation, everything else, was the initial public offering. In a period of a couple of years in the United States, 400 companies in this sector went public. Most of them cratered completely in the next few years, so obviously people had an IPO hangover. But now the question, at least in the United States, in a lot of people's minds, is what is going on with the initial public offering? Why are no companies going public? Other people think it's great that no companies are going public. No one's going to lose any money. We're protecting investors. There are other markets that are taking care of this, so this is a big topic. But most importantly, for anybody who is innovating or creating companies, there's this big question of where are you headed? Are you headed to an M&A where you sell the company? How do you get personal liquidity? How do you buy other companies? So this is definitely a very important topic for not only the United States, but everywhere else. Let me quickly introduce the panel. David Liu is a managing director at Jefferies, head of the whole digital media banking practice, helps companies raise money. Barry Silbert is the founder and CEO of a company called Second Market, which is a new startup in the United States that actually helps companies trade private stock. So a way of getting around actually having to go public and getting liquidity. And Matthew Bishop is a correspondent and editor at The Economist who has some great views on the U.S. regulatory environment and so forth. So let me just start off by saying, David, why does nobody go public anymore? Why is the IPO market dead?
So we're certainly starting to see some activity and signs of life. But if you look, for instance, in 2010 through actually 2008, so the last 3 years, it's interesting that there's really only been 6 U.S.-based companies in the internet and digital media area that have gone public. And that's a mind-bogglingly low number of companies. Most of the IPO activity, for instance, last year was out of the emerging market. So out of China, which accounted for half of the U.S. listings, and then India accounted for 1. So certainly the data shows there's very few IPOs, few and far between. You know, I think if I think fundamentally, there's a lot of reasons why we haven't seen a lot of activity in the last couple of years. But one of the main ones, frankly, is valuation. So obviously, when people go public, they're looking at public comparables. What other companies are similar to me? And our investment bank has an index where we track the trailing and forward EBITDA multiples of internet media companies. And if you look at the historical data, the fourth quarter of 2008 was really the bottom. The internet index traded at around 6 times EBITDA on a forward basis, which is a mind-bogglingly low number if you have a growing business. Today, that multiple is roughly around 11 times. So we've started to see a nice pickup in the valuations, which I think has caused companies to start thinking about the IPO as a financing alternative. Historically, in the last couple of years, that multiple was frankly too low. And I think in addition to all of that, there's clearly been a lot of inertia that's been built up through the regulatory regime, things like CEOs and CFOs having to sign off in blood, and then obviously the cost of going public has real incremental and real tangible impact on the valuation of a company, because obviously the costs associated with going public drop to the bottom line.
And so, Barry, I know you have some stronger feelings as to why people aren't going public and why they shouldn't go public. And what are those feelings?
Well, I think what most people don't realize is the IPO market has been dying a slow death over the past 10 years, and no one's really talking about it. This is not a recent phenomena where it's just a credit crisis that has resulted in companies not going public. For the past 10 years, you're seeing the number of IPOs going down. But what you're also seeing is the types of companies that are actually able to go public has completely changed from what was 10 years ago. 10 years ago, and even before, you could be a company that was worth $150 million and get an IPO done and be welcomed to the public market. Today, it's $500 million, it's $1 billion. And so the companies that are actually kind of getting out, they're these very, very large companies. But what it does is it creates this big vacuum that exists for all the companies, like my company, a lot of people here in the audience, that don't have the ability, don't have that exit opportunity. And so what has happened is there's been a tremendous need for liquidity for a lot of these shareholders of these companies. And what's exciting is there's a lot of demands now. And so for the first time ever, there's an opportunity to create kind of a spring training, if you'll give me that baseball analogy, where between years kind of 5 and 10, you can kind of grow into the point where you could then go public. And that's what second market's doing. So we're trying to kind of create this new market where companies can transition out early investors, you can bring in new investors, and you can get to the point where you then have at least the option of going public versus selling your company and ultimately cutting a bunch of jobs and destroying innovation.
So talk for a second about second market. What does your company do exactly? Can I raise money through second market? What are you doing?
Well, I'm going to take a quick step back and kind of tell you how we got started. So Second Market we launched about 5 years ago as a marketplace for lots of different alternative investments. And about 2 years ago, we got a phone call from a former Facebook employee who said, I just left the company, I don't have any money, I want to buy a car, help me out. And we hadn't created this market yet, and we said, okay, well, let's see if we can find some buyers for you. And to our surprise, there were a lot of people bidding on Facebook stock without having any information at all. They didn't know the cap table, they didn't know revenue, didn't know anything. And we took a big step back. We said, okay, kind of what's going on here? Why is there a company, a shareholder in a company like Facebook, not wanting to wait to the IPO? So we did some research, talked to a bunch of venture capitalists, talked to some private companies, and what we realized was that there was this growing reluctance for companies to go public for some of the reasons that Henry and David mentioned. So what we decided to do was create a new market where we actually work with a company, where we enable a company to create their own market on second market. So the company gets to decide who the buyers are. The company gets to decide who the sellers are. The company decides when the market's open. So it's not a 24/7 market like this casino public market we have. For a lot of companies, it's a once-a-year auction or a twice-a-year auction. And also importantly, companies get to decide what information they want to disclose to investors. But since they're doing it in a closed environment, companies are more willing to share more information than they would otherwise.
And who are the buyers? And I presume you're not doing this for free.
We are not doing this for free, but the buyers, it's interesting to kind of see how it's evolved over the past 18 months. In 2009, the first year we launched this market, we did $100 million in private company transactions across about 5 companies. In 2010, we did $400 million across 40 companies. And the buyers are primarily institutional investors, but also it's open to individuals who meet basically the sophisticated investor test, which is unfortunately just based on money.
And how much does it cost?
So the seller pays a fee when a transaction gets closed, and so there's no fees to access the market, there's no subscription fees, there's no fees to list, and it tends to be about 3 to 5%, depending on how active the private company stock is.
Matthew, you have another view on this. You're looking at the United States from afar, and I think have a view that the regulatory environment there is absolutely ridiculous, and that is in fact affecting what we're talking about here.
Well, yeah, I mean, I like to use as an example to understand these issues, to think about Facebook much like you'd think about the government of the People's Republic of China. They want all the benefits of popular democracy whilst retaining absolutely brutal centralized control. And they're trying to explore the tension between that. They realize they need the public's money, they need the public's creativity, to help themselves succeed, but they really don't want to let go and they want to snaffle as much of the spoils for themselves. And part of our problem, I think, is that, as many people in America tell me, the democratic model isn't really working for politics as well as we hope, because we have all these rather stupid voters who keep voting for the wrong thing. And in much the same way, the democratic structures that we've created around companies and raising capital don't work either. So we have this notion of a sophisticated investor, which I think basically means you have to be clever enough to understand that if you lose money, the government's not going to bail you out. But of course, as we now know, you can run Goldman Sachs and be bailed out by the government. So all people are unsophisticated in that sense. We have a situation where we have this absurdity of the roadshow before an IPO when they happen in America, where basically journalists are not allowed to report on the roadshow. So you have this whole process leading up to the shares going public where artificial secrecy is imposed. And you have fundamentally the dot-com bubble first time round being this moment where the public were lied to worse than any politician was ever lied to. That they were told they were being sold these incredible companies. I'm sorry to bring this up, Henry, which even those selling those companies thought were crap. I have this incredible pile of baseball caps that were worth more than the companies they were advertising from all those IPOs. And we simply haven't come up with an answer as to how do you engage the public and their savings in capitalism without absolutely creating a disaster? And now second market is an attempt to solve that, but it's really only a partial solution. And one of the challenges I think that we should all wrestle with coming out of this financial crisis, and which all you techie people in the room should be able to help with, is how on earth do we connect the public with capitalism in a way that's genuinely sophisticated rather than this farce that we have at the moment?
Yeah, well, see, this is a good point. Now that you raise the IPO issue and so forth, what is the job of the regulators, Matthew? Because a lot of people in the United States, especially after the dot-com bubble collapse, all during the 1990s, when the markets were going up, everybody wanted to be able to buy everything. They want to kill regulation because it's just getting in the way of me making money. Then, when the market crashes, suddenly says, oh, it's a regulatory failure. We cannot allow investors to be stupid and lose money. We must erect huge barriers to prevent them from being stupid. So what is the answer? What is the
let's think back let's take the Securities and Exchange Commission in America. In the late 90s, it was run by someone called Arthur Levitt, who spent a lot of time going around telling the public that they were being sold rubbish, but then didn't feel he had the power to do anything about it. He was replaced by a lawyer who basically hated the press, and then by the head of Donaldson, Lufkin and Ginrette, an investment bank who didn't do a very good job after that. Then we had a former politician who basically believed his job was not to regulate, even though he had regulatory powers. And now, I don't know what we've got. It's a complete farce. So the job of the regulator, I think, should be about helping the public to be informed, making sure that there's truth in advertising, and trying to engage public as much as possible. At the moment, it seems like it's certainly in America, a real mess. And what you have is these periods where that you have a lot of optimism, and so the politicians won't touch the capital markets, and then something goes wrong, and then they come in with a whole load of regulations that clearly the politicians themselves don't understand, which make life worse. So you have this situation where the rules that were brought in under Sarbanes-Oxley after the crisis at the start of the last decade basically shut down the IPO market, so it made it harder for the public to invest. And now I think this new Dodd-Frank legislation is even more of a dog's breakfast. So it's any idea what's going to happen to the efficiency of the markets now.
Yeah, I mean, it's been interesting to kind of see what's happened as a result of a lot of these rules that were enacted over the past 10 years. If you look at the public markets now in the U.S., upwards of 60% of trading in the public market is being done by high-frequency traders, which is basically it's computer algorithms that are driving all the volume. 10 years ago, it was like 5%. So that's scary alone. I mean, you look at the flash crash. I don't know, were you guys watching TV on May 6th? It went down by a year. So today it's less than 3 months. So what it means is if you are the CEO of a public company and someone is buying your stock in the market each day, the chances are it's a computer and it's going to hold on to it for less than 3 months. So what it means is the buyers do not care about what we are doing as CEOs thinking 1 year, 2 year, 3 years out. The buyer wants to make sure you're going to beat earnings for the next quarter. And to me, that's a broken market structure.
So, David, is that true? Is it just a terrible idea to go public because you have these greedy investors who are just only worried about the next 3 months, and then you can drive the company over a cliff, and that's totally fine, and who cares? And we should all go do things Barry's way and just have a 10-year horizon and so forth.
No. I think it's critically important that we have a healthy IPO market and that the best companies do pursue that as a financing vehicle, because if you look obviously at the venture capital industry, a lot of branding and a lot of high returns are generated through companies that go public, and ultimately VCs can hold on to their position for a long period of time. So I do think that we need to solve these issues, and I think that in general we're starting to see some traction in the market. It's tending towards the larger cap companies. There's some very interesting transactions in the market right now. One we're not involved with is Nielsen, which is a pretty large-scale IPO, $1.5 billion IPO, and I think that will be a little bit of a canary in the coal mine in terms of the market. But I don't disagree with the panelists in that, the regulators always tend to over-index, and the pendulum, I think, has swung a little too far. I think we're starting to see that retrench a little. But volatility in the market is here to stay. one of the things that we also track, which I think has also caused less IPO activity, is the IPO windows are much tighter now than they've ever been. You can see a market environment that is optimistic one month and then pessimistic the other. Because there's so many exogenous shifts that occur in the economy and the global marketplace that have a direct impact on the IPO market and people's willingness to take risk, that fundamentally there's going to be a lot of volatility. So when we counsel companies on pursuing the IPO route, we spend a lot of time talking about the volatility, the quarterly earnings, all the challenges of being a public company. And look, the IPO option for financing and ultimately for liquidity, frankly, is a relatively privileged crowd. There's only really a handful of companies that we believe have the rigor and the discipline and the business model to ultimately be a public company. The vast majority of exits, the vast majority of companies are going to reach liquidity through an M&A event. And that's generally where guys like me make most of our money.
And is it possible that, in fact, this goes to Matthew's point, Facebook has actually figured out the perfect structure? Because what they did was what they're doing is basically a private IPO through Goldman Sachs to Goldman Sachs's richest international investors. They don't have to deal with the SEC because it's outside the stupid, stifling regulations of the United States, in Matthew's view. They get to raise all the money they want privately. They don't have to deal with any pain in the neck, public shareholders. They don't have to have documents they file. They don't have to justify their position. They have stock trading on Barry's market at these tremendous valuations. Presumably they can buy other companies with it. Is that what we should strive for? Should we just eliminate the public markets?
Well, I think on top of it, I think yes, if you can. But last time I checked, there's only one Facebook. So the reality is that there's going to be a rarefied few companies that have the ability to, have this effectively pseudo IPO, and based on data I saw on your website, the valuations that they got were astounding. Way beyond what you see in the public market. So yes, I mean, if you have that option, if you have that Facebook option to go public, that's fantastic. But again, there's only one Facebook.
It's a new world. It's a new world, and the folks at Goldman Sachs are really smart people, and they figured out a way. And Facebook is certainly a very unique company. But I can tell you that after that deal was announced, most major banks in the U.S. reached out to us to find out how they could get involved in these types of deals. And what's happening right now is people are realizing that for the first time ever, they can get access to these really exciting companies, the fastest growing companies in the world, and not have to wait for an IPO. And I think that's game changing.
Yeah, I think Facebook's one mistake was to go with Goldman Sachs, which is toxic now in American media, and so I think the SEC may find themselves forced to take a greater interest in this market than they might have done, because the great vampire squid, as it's become known, is putting its tentacles all over this market. So, but ultimately, the problem with the current public market that we've got, is that it's incredibly short-termist. So, we get the typical share is traded 2 or 3 times a year, whereas 10 years ago it was every 3 years. And so you've got this incredible short-termism, which is the product of all the institutions that we all use to put our savings to work. Now, it's going to be our money that is still going to be invested in all these firms through private equity, through this intermediary market. So I do think we need to make sure that it is a public market in some sense, and there will, in the sense that it is genuinely accountable to us and does a better job than what we've got at the moment, which is pretty awful in my view.
So look, I think this has been kind of a depressing panel so far, but let me tell you some good news. The good news is that every single day there are hundreds of new investors that are now trying to get involved in this market, and that is great for us as entrepreneurs. It's great, I think, for job creation. It's great for innovation, and ultimately free markets are going to figure out a way. We're regulated. We've been dealing with the regulators for 5 years. It's not that big of a deal. It certainly is reported differently, but this is a great thing that's happening right now, because we're creating a third alternative for companies, for shareholders. Instead of waiting for an IPO, instead of doing an M&A transaction, we're going to give you an option so you can do something else and get some liquidity.
And the other very positive thing to say is that over the last 10 years, really, we've had the capital markets generally, both in the United States and internationally, Europe, everywhere else, fully develop right from the seed level. We had Seed Camp yesterday. We had a few of the incubators. There's a huge angel network now. So right from the beginning, you can get institutional capital and individual capital through VCs, through private equity firms, and now on the private side. The good news about the IPO market, if we can get it going, and I want David to talk for a second about the pipeline, which actually looks very good, so things may change here, is that it is, or was, when it was functioning well, the cheapest source of capital, huge source of liquidity. From the perspective of an investor, obviously, it doesn't matter whether a stock trades once every few seconds. It's good. It's more liquidity, get it out the door. CEOs can pay attention to the investors who focus on the long term if they like, so forth. There's no reason to pay attention to the high-frequency guys necessarily. So there are a lot of advantages to it. But David, talk about what's coming, because I think, as you say, some of the IPOs now could be canaries in the coal mine. The IPO market has always gone through these cycles where a big company will come out and unlock the gates and then everybody charges through. Do you think that that's possible over the next couple of years?
Yeah, so the explicit pipeline, which everyone can see publicly, are the U.S. companies that have filed on registration. And in the tech, media, telecom arena, which I cover, there are approximately 30 companies on file. What you don't see is the shadow pipeline of companies that are running banker bake-offs, so interviewing investment banks, and it certainly feels like we're in full swing right now. And I would say, if I were to take a broad swag, there are probably 30 to 40 companies in and around that shadow pipeline. In addition, what you don't see are the foreign companies that have come to the United States and are looking to go public, because foreign companies from China and India can file under confidential filing. And I can tell you there's a tsunami of companies coming from China looking to the U.S. market. If you look in 2010, 60% of the IPOs were from China and India. So we see a rapidly growing pipeline of companies. But if you look on a historical basis, the median number of IPOs in the tech and media and telecom area has hovered around 40 to 50. And certainly there's plenty of capacity for a lot more than that. So we're very optimistic that there's going to be a lot of supply and there's going to be a lot of demand. The challenge is the matching point. What types of companies ultimately will investors pay a reasonable premium for? And when we look at the data and we speak to public investors, they're not really interested in Me Too situations. They're really looking for relatively unique companies that are market leaders in their space. They're looking for companies that have growth that over-indexes the overall economy. And you know, in this environment, any company growing north of 20%, I think certainly is some is an IPO-able worthy candidate. So the bar is certainly higher for IPO-able companies, but the trends are definitely in a positive direction.
Great. We're running low on time. I want to take a couple of questions, but I have one final question, which is normally the time that everybody starts to get excited about IPOs is right at the peak. There have been a lot of signs lately that we are nearing some sort of bubble. People look at the Groupon valuation. They look at the Facebook valuation. People trading at $70 billion on Barry's market with no financials. Nothing. They don't even know what the company's doing, and they're paying that much. Are we in a new bubble, and are we going to crash?
Well, I think we're in a different sort of bubble if we are in a bubble from what we had before. I mean, because the public markets haven't been engaged in it. So I think it's much more of a sense that there's a lot of wealthy people in Silicon Valley that fancy themselves as super angels and are using this spray and pray approach where they think they throw enough money at enough companies and one or two of them will win. And Alan Greenspan famously used this metaphor of a lottery ticket when he was talking about .com last time, that we all are willing to slightly overpay for a lottery ticket because we want to be in with a chance of winning the big one. I think there's also a war for talent where essentially companies like Google and Facebook are in a hiring battle, and there's a sense in which they'll buy a company rather than buy an individual, and they're willing to pay over the top to be seen as winning in the pissing match on who's the best firm to work for in the Valley.
So I'm gonna tell you guys a secret. The secret is that talks of a bubble sell newspapers, it gets people to watch TV, and it gets people to read blogs. Separate out Facebook and Groupon from all the other exciting companies out there, and maybe valuations have gone up, but maybe it's because these are great companies, maybe because there's a lot of capital coming into this marketplace, and you know what, it's actually kind of a good thing, because it's going to enable new jobs to get created, and it's going to enable new companies to get started. You got to remember that there's a lot of service providers that make money off of IPOs. Bankers, like my friend here, exchanges, accounting firms. So everybody's going to talk about this new IPO boom that's going to happen or is happening, but you ask any CEO who has gone the public route and the private route, they will tell you nine times out of 10, they will never, ever go public again. And I think that's telling.
My last comment on what I've learned in my career is that crises and bubbles rarely happen when everyone's talking about it. I think they happen when no one's talking about it. So I do think that there are air pockets. I think there's certainly areas where I'm worried that there's too much euphoria. But in general, I don't think we're in a bubble. I think that there are a rarefied few number of companies that are getting these massive valuations. I think in general they're well justified because they really are game-changing companies. But I think the vast majority of the investment landscape that we see today is still very disciplined.
Right, and people have been screaming about the bubble in Facebook from 2 billion on up, so they'll be right someday. Any questions?
Hello?
Felix? Sorry. Oh.
Barry, can you talk about your plans for Europe?
Question for Barry is, what are your plans to bring Second Market to Europe?
Okay, so our strategy is we identify the best companies in a region and start working with them, getting them trading on Second Market. So we started in the US. We have an office in Hong Kong, so we're working with some companies in Asia. We just opened up an office in Israel, so we're working with companies in Israel. And Europe is our next plan for growth.
Felix?
Yes, Felix Hammond from Reuters. Facebook has said that it's going to file its financial data with the SEC in 2012. So I'd like to ask all four of you, once that happens, is it going to go public or can it stay private?
I can't speculate on.
I'll speculate. I don't think it's going public. I don't think they have to. They may at some point, but all they're required to do is file the financials.
Yeah, that's right.
Yeah, I mean, it's back to China again. I mean, is China going to go democratic? I think it's just going to gradually release more information and give people as little as it can get away with giving them whilst retaining power and growing more and more powerful. And I think Facebook's going to do the same. They've structured it perfectly so that they can retain control.
Great. Thank you very much.